Hello to all traders and welcome to this Monday's first market size video on the indices. Today we're going to talk about the S&P 500 as well as the US index, the basket of majors. Now, last week we saw the equities taking a breather from the big plunge that we've seen the week before. That was partially due to Fed's message supporting more stimulus in case, of course, is necessary. He called on the Fed, the government, again to not actually retrace back their fiscal support, but we are going to take at least until July to have more clarity on that. So until then, markets can assume that the Fed will step in when and if necessary. Now, the thing is that with economic data improving, markets seem to be optimistic. However, then there is new cases that they are rising in China as well as in the US. And just yesterday on a Sunday, we had a record second day in rises in coronavirus cases in the US. And I'm not sure that is really spelling a good story here. Now, the truth is that the rally was somehow supported or remained firm because of US/China developments. Apparently, the situation there is going pretty well, but I'm pretty sure we're going to hear about something going off pretty soon. On the European side, we've had, we have the EU summit today with China video conference, and there's going to be a very interesting and critical discussions taking over, and that might have an effect on the US-China trade as well, on how Trump responds to potential negotiations between the EU and China in retaliation, of course. What we need to pay attention to is that how the employment situation is unraveling in the US. Okay, and from what I see is that we still have people filing for unemployment benefits, and that might be spelling a hard times going forward for the dollar and also for the U.S. economy, of course. France on the other sides of the continent shows to Europe that we can really keep COVID-19 in check after the reopening, whereas Apple closing stores again after reopening them doesn't really say that in the U.S. the situation is the same. Now, I'm not going to keep you longer on this end. I'm just going to jump to the charts with the S&P 500. We called this move down here, and we're expecting a wave B, and then now we're expecting wave C. That will be perhaps A, and then we're going to get a B and a C. Right now, we took out the 61.1 Fibonacci retracement of wave X. Right, that seems to suggest that we could see prices now moving lower. Okay, what we really need to pay attention to is the shorter term decline over here, this downside leg, right? So if we pull down the Fibonacci retracement, we've already taken out the 78.6, we're taking out the 50, and we had just had a retracement back to the 50. Now we are back above the 3,000 mark. However, I don't think this is going to last, okay? So in case we remain below, let's say 3120 or so, because it's a good activity level, most likely we're looking for this to be respected in this ABC relationship. If not, and we break higher, then this simply would mean that we're going to see this being an A, this being a B, this being a C, and this is going to be the first wave. That's going to be a W. Right, then we're going to get the X, and then we're going to get the Y up here, which means we're going to get prices, perhaps falling a little bit further, okay, down to 29.87, and then having another upside move to take out the, 31.20 or so, but without breaking above the previous high, right? So the situation here is two scenarios, A, B, C, or A, then B, and then C, okay? Now, the other scenario, of course, is that, this is a simple correction, okay? And this is not a wave A and a B and a C, this is simply a wave 4, and we're gonna move up for wave 5. That will suggest, again, that we'll have 1, 2, 3, 4, and 5 is a complete different scenario, but still in play. Now, the next downside move, the moment we break below the 61.8, will be the 27.87, and this is where I would start looking for prices to either, start moving up again or just retrace a little bit and move down. Now, on the US index, guys, we've got, exactly what we're talking about here last week. We've had wave 1 done, or A, okay, and we're expecting wave B to complete, or 2, okay. We saw this as an ABC. I still see this as an ABC, but similarly to the S&P as well, it could be a case where we'll have A, B, C, and this is just a W. Then we're going to get X, and then we're going to get Y. The thing is that if we take the extension of this Fibonacci, wave A, the 27.2, which is usually seen in corrections, takes us to 97.97. Now, the 97.97 is far from even the 38.2 Fibonacci retracement. So for that reason, I think that we might be on a complex pattern here, a zigzag. Potentially this is going to be an ABC, then we're going to get an X and then an ABC. If we get that, we're going to get at least to 98.49, and that would actually suggest that at least we are respecting the relationship of this correction in better terms, because I don't really like this to be the end of this correction to the upside. And the truth is that even if we pull the Fibonacci extension, well, it's not even the 100 Fibonacci extension, okay? I mean, it's like 98.14 is the 100. So, well, in case we get something like that, then that would be more chances to, the 100 at least, and in between the 50 and 38. That will make a much better correction. And from there, we should start looking for prices again to fall below the previous low, below this previous low, okay, or even perhaps the same price, 94.62. And from there, we can start looking for prices to really understand whether we're going to have an impulse move continuation to the downside as 1, 2, 3, 4, and 5, low, wave 3 or wave C. Okay, so that will be all for the day. Thank you for watching, and I will speak to you again tomorrow.